Every way to fund an acquisition. Most buyers walk into a deal knowing exactly one source of money: the bank. Professionals stack 3 or 4 sources into the same deal, and that difference is usually the whole reason one buyer closes while another loses the business they spent a year chasing. This breakdown comes from Raises.com, the capital-raising platform behind buyers like Aid, who went from aspiration to 2 closed acquisitions. Hunter Baloo of Roofing.com, who bought and sold a company inside 1 week. And Tempest 22, which grew from single hotel deals into a $50 million private equity fund. In the next few minutes, you get all 8 funding sources, what each one really costs, and how they stack. Miss one, and you may be leaving the deal on the table. Start with the door most first-time buyers walk through, the SBA 7A loan. Here is the problem it solves. A bank looks at you, no track record, no collateral, and every instinct says, decline. So the United States government steps in like a cosigner with deep pockets, guaranteeing up to 75% of a loan as large as $5 million. Suddenly the bank can say yes. You bring roughly 10% down, the business pays the loan from its own cash flow over 10 years. 2 catches decide everything. They want your personal guarantee, and they want the business earning at least 1.25 times the loan payment after paying you a real salary. Clear those 2 bars, and this is the cheapest big check a first-timer will ever hold. But what if the bank still will not cover the whole price? Think about what the seller knows that no bank ever will. 20 years of customers, every hidden problem, every real number. A seller note puts that knowledge on your side of the table. The seller lends you 10 to 30% of the price and becomes your second bank. Monthly payments, 5 to 8% interest, usually 5 years. Why would they ever agree? A faster close, taxes spread across years, and often a better total price. Why should you love it? Every dollar the seller finances is a dollar you do not have to qualify for, and a seller collecting payments answers your phone calls after closing. One trap: your senior lender will want that note on standby, meaning the seller waits if cash gets tight. Negotiate that before the signing table, not at it. Now, what about the cheapest money in the whole stack? The conventional bank term loan. It's the cheapest capital you can put into a deal, and the hardest to win. No government guarantee stands behind the bank, so they underwrite like detectives. 3 years of clean financials, hard collateral, coverage north of 1.5, and a buyer who has done this before. If you qualify, you skip the SBA fees and win a lower rate. Here is the move almost nobody uses. Start with the bank the seller already uses. They have watched this company's deposits land every week for a decade. They already believe in the business, and they do not want to lose the account when it changes hands. The warmest lender meeting you will ever get is the one where the bank already knows the numbers. But debt only ever covers part of the price. Where does the down payment come from when your savings are not enough? Here is the wall every ambitious buyer hits: the perfect deal and not enough cash for the equity slice. Investor equity breaks that wall. You offer people a piece of ownership in exchange for the down payment. Dentists, executives, family offices, people who want returns without running anything. The standard shape: investors earn a preferred return, often 8%, before you touch $1 of profit. Then the remaining upside splits. Burn this into your head: 5% of a company you own outright beats 100% of a company you never buy. And the wrapper matters. In the United States, that usually means a Regulation D exemption with real subscription documents. That paperwork is what Raises.com builds for buyers every week. Because sloppy documents do not just kill deals, they follow you into court. So how do you buy a business when even the seller's price itself is the problem? Every seller believes their business is worth more than it is. The earnout is how professionals end that argument without ending the deal. It works like this: The ask is $3 million. You believe 2.4. So you pay 2.4 at close, and the remaining 600,000 arrives over 3 years, only if revenue stays above the agreed line. Picture a rope bridge between your price and theirs. If their numbers were real, the seller crosses and collects every dollar. If the numbers were inflated, the bridge simply never finishes, and you never overpaid. One rule keeps this clean. Tie the earnout to revenue, never to profit. Profit has 1,000 definitions, and every one of them starts a fight. Revenue is a number nobody can argue with. Now flip the whole board. What if the money gap sits between the bank and everything else? Sometimes, the numbers just do not meet. The bank stops at 70%, your equity reaches 15%, and a gap yawns in the middle of your deal. Mezzanine debt is the scaffolding that fills it. It is expensive, 12 to 20%, part paid in cash, part accruing, often with a small equity kicker called a warrant. Sounds brutal. It is still cheaper than handing away a bigger slice of ownership on a business that cash flows hard. The discipline is in the exit. Professionals treat mezzanine like scaffolding on a building, essential during construction, gone the moment the structure stands. Use it for the 2 or 3 years you need it. Refinance it out, and the ownership you kept pays for the interest many times over. Which raises a sharper question. What if the best lender in your deal is the person selling it? There is one due diligence signal stronger than any accountant's report. The seller keeping their own money in the deal. Rollover equity means the seller retains 10 to 30% of the company they just sold you. Sit with what that means. The one person who knows every skeleton, every fragile customer, every soft spot in the numbers. Just bet their own wealth that you will grow this business. It shrinks the check you need to write. It keeps their phone on for you after closing, and it aligns everyone on the same upside. And the reverse tells you just as much. A seller who swears the business is healthy but wants 100% of their chips off the table is answering a question you have not asked yet. Slow down and find out why, which leaves the last source, the one everyone gets, exactly backwards. Here is the number that surprises everyone. In a well-built acquisition, your own cash is the smallest slice on the table. That is not a loophole. It is the entire discipline you just learned. Stack it. An SBA or bank loan carries the base. A seller note bridges the middle. Investors and rollover equity close the gap. An earnout absorbs the price argument. A $10 million business changes hands, and the buyer's own check is a fraction of the price. Your cash has a different job. It is the signal of commitment, and it is the cushion, because every business hides a surprise in the first 100 days. A failed roof, a lost customer, a slow month. The buyer who empties the tank at closing owns nothing but stress by day 90. Keeper powder for the fight after the fight. That's how professionals fund acquisitions. If you are buying a business or real estate, and the money part is the wall, there is a free strategy call linked in the description. A professional advisor walks your deal with you. Subscribe for one deal concept at a time.